The next time the market drops, what's your plan? Many people are prone to panic. The red numbers come on the TV, the cell phone notifications, the noise dial gets cranked to 10. It wasn't that fun in the past, but now you're in your 50s, let's say, and retirement is just around the corner. Now is not the right time for a market correction. So what do you do? Well, the right move is actually something that you should do before the market drops. And having had hundreds of chats with pre-retirees just this past year and reviewing or kind of auditing those retirement plans, it seems so very few pre-retirees actually do this one thing. It turns out it's actually not even that hard either. It just takes a little bit of foresight. So in this video, I'll share with you what you need to do before the market drops if you're planning to retire, especially in the next few years. I'll pull on some fascinating data that I'm almost certain that you haven't seen, and then we'll walk through a case study to show you how this looks in real life so that you can kind of see how different things might look versus how most pre-retirees kind of conventionally plan for these types of ugly events. And I tell you, this one's fully loaded, so let's dive right in. So if you've invested for any kind of reasonable amount of time, we know that market drops happen every few years. Looking at this data here, while 17 of the last 20 years have had positive returns for US stocks, there were, of course, 3 down years. But along the way, we've also had those down dips within every year, or kind of what smart people like to call intra-year drawdowns, as shown here. The little red dots show what US stocks did on their journey towards those calendar year returns. So these short-term stumbles that happen inside every year can actually be kind of scary, but they shouldn't be surprising. These short-term slumps don't necessarily mean a full year fall. So this is a 20-year history and a recent 20-year history at that. Your retirement, though, is probably going to be longer than that. It might be 30, 35, maybe even 40 years long. It's a really long time. So when we're planning for your retirement, when we're running these models, these projections for folks, like we do all the time, we really need to factor in the variability of those returns. And while studying history certainly kind of doesn't allow us to perfectly predict the future, it probably does give us a pretty reasonable method to kind of set baseline expectations about what could happen in the future. Now, let me show you what I mean. So here's a different and probably overwhelming way to look at returns over various periods of time for the S&P 500 going all the way back to 1926. So this triangle gives us a way to triangulate the annualized returns between different periods of time. And over here is a heat map of all of those returns converted to shades of green and red based on kind of positive and negative ranges. So just so we're on the same page, and as an example, let's zoom in here to look at the return between 2014 and 2023 for the S&P 500. Looks like it was about 12%. And as another example, here from 1994 to 1999, the annualized return was 24.1%. And right down here at the bottom left, we see the total annualized return over this entire time period from 1926 to 2023 looks like it's about 10.3%. That's quite the range. So now we know how to use kind of a cool tool like this. Let's spot check a few interesting periods of time in history to see what we might learn as we prepare for our own retirement. So on the heat map up here, again, we see this kind of red line, which indicates a prolonged period of really lousy returns in the US back in the late 60s and the early 70s. So say from 1968 to 1975, it looks here that there was annualized returns over that period of negative 1.5%. Not great. Now, assume you survived that sucky period, you didn't do anything dumb, and then you finished out your retirement in 1988. You clocked in a 9.6% annualized return. So a period of stink, but you still ended kind of awfully close to that long-term average of 10.3. Other really lousy period here, of course, was the lost decade from the year 2000 to 2010, which earned you a negative 0.9% return if you had held large US companies over that 10-year stretch. Imagine retiring at that point in the year 2000. Now, in a minute, I'll show you how you can actually stress test your retirement against all of this data. just to see how you would have fared if you had entered your retirement at the start of one of those nasty periods. I'll get to that in just one sec. But first, I can already hear some of you saying, well, sure, nice data, Steve. That's the US. What about up here in Canada? So let's look at the TSX composite. Now, this isn't going to go back as far to 1926. This is going to go back to 1957. But that's still a decent bit of history. So let's grab some, sample periods here, just as we looked at in the US. So from 2014 to 2023, the TSX composite earned an annualized 7.6% return. From that 90s period, so from 1994 to 1999, it did 10.7%. And then that really nasty lost decade period that we saw in the US, where it earned essentially nothing for 10 years, Canada had a 5.6% annualized return up here in Canada from 2000 to 2010. Now, going back all the way to 1957 to 2023, the Canadian market generated an 8.9% total annualized return. So a little bit less than the US, but really not bad. This is wild. Just think about all of the crazy stuff that happened in the last 60 years, right? We had a Cold War, an Arab oil embargo, US inflation that hit 13%, the 1987 flash crash, the Asian currency crisis, the Y2K scare. You remember that? The dot-com crash, 9/11, subprime mortgage crisis, Brexit, COVID. That's crazy. This shows as just pure data on a table here, but keep in mind, these were real moments in history, right? People lived through all of those things. You probably lived through all of those things. And despite, or perhaps in spite of all of that craziness, and you essentially earned a 9% return in Canada and a 10% return in the US. That's absolutely wild. But while we're here looking at stocks, one thing most people probably wouldn't know, this data actually shows that some factors have outperformed the broad market as a whole, specifically smaller, cheaper companies. Again, looking all the way back to 1926 to 2023, that subset of US companies, of smaller, cheaper priced companies, has actually produced a meaningfully better return than all stocks generally, coming in at about 13.2% annualized. And it's not just because of something that happened back in the 40s either. Say from 1990 to 2023, 13.4% annualized return versus 10.2% return for the S&P 500 broadly over the exact same time period. Or let's look at the start of that nasty lost decade from 2000 to 2023, 12.2% for this basket of smaller, cheaper valued businesses versus 7% for the S&P 500 over that same 23-year stretch. Now, there's actually a way to tilt your portfolio to capture some of these kind of extra expected return premiums too. And it turns out the data that actually makes this all happen isn't really just a US phenomena either. It's a return premium that exists kind of around the world. But I'll save that for another video. Maybe just kind of make a note in the comments if you'd like to see more on that down the road. So clearly your experience with the stock market can really vary drastically depending on your timing. The good news is that with time, most of that chop ends up getting smoothed out. But most retirees won't just own stocks in their portfolio, they'll also have bonds. Bonds are supposed to kind of be the safe stuff, right? The less risky stuff. So when we look here at the heat map for the FTSE Canadian Long-Term Bond Index going back to 1948, we do see much less red, but we still do see some. Notably here in the last few years where bonds have struggled as interest rates went from 0% to 5% in almost a single year. But take that same time period where the US stocks stunk, right? So from 2000 to 2010. Long-term Canadian bonds generated a 7.8% return over that period. And going all the way back to 1948, this index earned a 6.7% rate of return. Naturally, less than stocks, which you should expect, right? But generally, most of the time, the safe stuff seems to be doing its job, right? It's namely doing something different, like diversification. And we can really spend all day kind of going through this stuff. We can look at this from kind of an inflation-adjusted basis. We can look at the NASDAQ, global stocks, REITs, all of that. But the rubber really needs to meet the road here in your planning. How can you actually use this? And so here's what I would do. Let me show you. But first, by the way, if we haven't ever met, my name is Steve Willems. I'm a practicing certified financial planner. and wealth advisor with the Willems Wealth Planning Group out here in BC. We started this channel a while ago to help you plan for your own retirement, helping you think about how to plan and arrange your investments, your income streams, ideally pay less tax along the way. And most of the time when someone's running a financial plan for you, they're typically going to use a flat line rate of return assumption kind of based on your current or recommended asset mix. Looking at capital market expectations research from FB Canada and maybe other evidence-based planning groups will then land at a number to use in your retirement income plan. And when we do that, what you'll find is that it's going to be a fair bit more conservative than any of the numbers that we've been looking at here so far on all of these matrices, right? Because when we're planning, we really want to be investing like optimists, but we want to be planning like pessimists, right? So by now, you should see that there's a massive problem with this conventional way of building a plan, right? People forecast in straight lines, but economies, countries, and markets, they run in cycles. They do not run in straight lines. So let's hop into that case I mentioned. Here's a sample plan that we're working on. Let me introduce you to Ted and Trish Lasso. And here's what their net worth projection looks like, say based on a 5% growth rate on their liquid assets, kind of based on what they hold, right? Now, what I would do if I were Ted or if I were doing this for you is we would also want to see what this might look like if you happen to retire tomorrow and tomorrow really ended up looking and feeling a lot like the year 2000, the start of that really crummy period. Or maybe the other nasty year, 1968, one of those red periods. And instead of using a fixed 5% return assumption, if we change that figure every year to mirror that of the past period. Again, hear me out. I'm not saying that history kind of repeats. I'm not saying that this is a prediction, prophecy, or anything like that. But we do find it should help us prepare ourselves both kind of emotionally and financially for what that could look like should something like that play out for you. So first, we're going to pull all that market performance data into the system, and then we're going to apply it to the same case before that was just before illustrating kind of that straight line return projection off into the future. First, we'll start with the data from the 1968 period. Now, completely unexpected results here, but pulling in those returns and then running them forward, we see that the Lassos actually survived the 70s. And then by the time the solid returns of kind of the late 70s and 80s come around, their plan is absolutely crushing it. The key is that they survived the lousy period at the start. They still had the cash flow that they needed. They skated through it. They stuck in their seat when the bounty arrived, which was the much better returns in the 70s and the 80s. So that actually looked surprisingly good. Like I was shocked when we ran this scenario. But what about if we took an even more sour look? What if we used a rate of return randomizer to run a scenario where 4 of the first 7 years of Ted's retirement is negative? Now you'll recall we saw at the start of this video kind of data where we saw 3 negative years in the last 20. So this, 4 in the last 7, like that's going to be particularly sucky. And looking at the results of that projection, while it's certainly not going to be as fun of an experience, maybe not as pleasing, mathematically this too also still works. We're not seeing any forced downsizes here. There's still a nice RIF meltdown strategy running. They even have some flex money here in a non-registered account. It's not terrible at all. Now, I have no idea what returns will be over the next 30 years. Whatever they may be, I can guarantee that all of the same human emotions that created the past crises, right? Fear, greed, envy, those will still be with us in the next few decades. They're not going anywhere. But so too will resourcefulness, right? The desire to kind of wake up every day and make a better life for yourself, the ability to solve problems and create solutions. And so as you plan for your own retirement, the point shouldn't be to try to be perfectly right about the future. The goal should just be trying to be a little bit less wrong tomorrow. And what we've found is that this kind of historically based forecasting or projecting helps us add an extra dose of confidence to a retirement plan should you feel still a little bit uncertain about your financial footing. Of course, the bear market response plan will still kick in when the market actually drops, right? The rebalancing, the tax loss harvesting, kind of sticking with the plan, avoiding nasty mistakes. This is really about what you need to do before that market correction happens, just so that you've got what it takes to stay in your seat. I really hope that helps. If you haven't done this kind of like robust planning work yet and you're looking ahead to a season coming at you sooner than you realize, I suggest we have a quick chat just to see if it makes sense to help you get some answers to your questions. I'll put a link in the description below if you want to make that happen. Otherwise, thanks as always for watching. I'll see you in the next video.